Okay, so this is for the subject monetary policy and central banking, and for this particular video, the topic would be comparison of fiscal policy and monetary policy. So we have here an article from investopedia.com, and we'll go over the content. Okay. So when it comes to influencing macroeconomic outcomes, governments have typically relied on one of two primary courses of action: monetary policy or fiscal policy, sometimes both. Okay? Monetary policy involves the management of money supply and interest rates by central banks. To stimulate a faltering economy, the central bank will cut interest rates, making it less expensive to borrow, which would encourage people to, borrow and then spend that money, while increasing the money supply. And in that sense, it does increase the money supply. When more people borrow money from the banks and then spend that money to stimulate economic activities. Okay, if the economy is growing too rapidly, the central bank can implement a tight monetary policy or contractionary monetary policy by raising interest rates and removing money from circulation. Okay, this is normally to curb inflation. Okay, and then we have monetary policy, on the other hand, determines the way in which the central government earns money through taxation and how it spends money. Okay, so to assist the economy, a government will cut tax rates while increasing its own spending. So again, what happens when they cut their tax rate? So more the businesses and the individual taxpayers will have more money to spend, and then government, they can also increase their own spending. When they spend the money, of course, the money goes into the market, and so the money supply increases. Okay, and what else? To cool down an overheating economy, it will raise taxes and cut back on spending. So on the other scenario, if the economy is growing too fast and there's inflation, there's a need to curb inflation and decrease the supply of money in the market, then the government can raise taxes. So by raising taxes, the businesses and individual taxpayers would have less money to spend. They would have to pay their taxes, and so the money goes to the government. And then the government can also cut on their spending so that there would be, less money in the market, right? There is much debate as to whether monetary policy or fiscal policy is the better economic tool. Essentially, they have, different roles, different tools, and although they have almost the same, objectives to support economic growth and to curb inflation, and to increase employment rate, but still they have different territories. Okay, each policy has pros and cons to consider. Key takeaways, normally these are just repeats of the main points. Central banks use monetary policy to keep economic growth in check, monitoring and control, and stimulate economies out of periods of recession. While central banks can be effective, there could be negative long-term consequences that stem from short-term fixes enacted in the present. Thirdly, fiscal policy are the tools used by governments to change levels of taxation and spending to influence the economy. Fiscal policy can be swayed by politics and placating voters. Normally, politicians, they would, decrease tax rates so that businesses and individual taxpayers would like them, right? Which can lead to poor decisions. This is the negative effect of that are not informed by data or economic theory. Okay? If monetary policy is not coordinated with fiscal policy enacted by governments, it can undermine efforts as well. So this is why both regulatory authorities, the central bank and the government, should in a way coordinate or communicate what they're planning to do with their respective policies. Okay, so that in a way it should be complementary, help each other out. So overview of monetary policy, actions taken by a country's central bank. Here in the Philippines, we have the BSP, Bangko Sentral ng Pilipinas, to achieve the macroeconomic policy objectives. Some central banks are tasked with targeting a particular level of inflation. Yes, we do that here in the Philippines. In the United States, the Federal Reserve Bank, the Fed, has been established with a mandate to achieve maximum employment and price stability. we do here as well. This is sometimes referred to as the Fed's dual mandate. Most countries separate the monetary authority from any outside political influence that could undermine its mandate or cloud its objectivity. We try to. As a result, many central banks, including the Federal Reserve, are operated as independent agencies. Operated independently, but they do have a link to the government. When a country's economy is growing at such a fast pace that inflation increases to worrisome levels, alarming levels, the central bank will enact restrictive monetary policy to tighten the money supply, effectively reducing the amount of money in circulation and lowering the rate at which new money enters the system. Okay? Raising the prevailing risk-free interest rate will make money more expensive and increase borrowing costs. When borrowing costs are increased, so there's, reduced demand for cash and loans because, less people or less businesses would borrow money because of, high interest rate. The Fed can also increase the level of reserves commercial and retail banks must keep on hand. BSP can do that as well, limiting their ability to generate new loans. And then thirdly is selling of government bonds, selling or buying, depending on what needs to be done, either to increase or decrease the money supply in the market. Economists of the monetary school adhere to the virtues of monetary policy. When a nation's economy slides into recession, these same policy tools can be operated in reverse, constituting a loose or expansionary monetary policy. In this case, interest rates are lowered to encourage borrowing, and so, businesses and individuals would have more money to spend. And then reserve limits loosened, the banks would have more money to lend to businesses and individuals, and bonds are purchased in exchange for newly created money. Okay, by purchasing, the central banks would, release money into the market. If these traditional measures fall short, central banks can undertake unconventional monetary policies such as quantitative easing. Okay, we'll discuss that sometime later on. Okay, comparison, monetary policy, pros and cons. So pros of monetary policy, advantages. Interest rate targeting controls inflation. A small amount of inflation is healthy for a growing economy, as it encourages investment in the future and allows workers to expect higher wages. Inflation occurs when the general price levels of all goods and services in an economy increases, raise prices. By raising the target interest rate, investment becomes more expensive and works to slow economic growth a bit. Okay, when interest rate goes up, businesses and individuals are discouraged from borrowing money, and so with less money on hand, they cannot expand their operations, or they cannot spend. They have no money to spend. Okay, another pros can be implemented fairly easily. Central banks can act quickly to use monetary policy tools. Often just signaling their intentions to the market can yield results. Central banks are independent and politically neutral. Even if monetary policy action is unpopular, it can be undertaken before or during elections without the fear of political repercussions. That's the goal, but sometimes there is a bit of an influence there. Weakening the currency can boost exports. So sometimes, monetary policy would intentionally weaken a certain currency so that they can support exports, right? Increasing the money supply or lowering interest rates tends to devalue the local currency. A weaker currency on world markets can serve to boost exports, as these products are effectively less expensive for foreigners to purchase. The opposite effect would happen for companies that are mainly importers, hurting their bottom line. Bottom line is the profit. Okay. And then for the cons, disadvantages, effects have a time lag, so there's kind of, time difference. Even if implemented quickly, the macro effects, cannot be felt immediately. It would take time before they, whenever they infuse money into the market, it would take time before the money gets into the hands of the ordinary citizens. And whenever they retract money, it would also take some time before the effects are felt, okay, on a national level or on a bigger scale. Okay, the effects on an economy may take months or even years to materialize. Some economists believe money is merely a veil, and while serving to stimulate an economy in the short run, it has no long-term effects except for raising the general level of prices without boosting real economic output. Technical limitations. Interest rates can only be lowered nominally to 0%, which limits the bank's use of this policy tool when interest rates are already low. Keeping rates very low for prolonged periods of time can lead to a liquidity trap. This tends to make monetary policy tools more effective during economic expansions than recessions. Some European central banks have recently experimented with a negative interest rate policy, but the results won't be known for some time to come. Monetary tools are general and affect an entire country, yes. Monetary policy tools such as interest rate levels have an economy-wide impact and do not account for the fact some areas in the country might not need this stimulus. So currently, in this pandemic, essential businesses, they're not really that affected, but whenever monetary policy increases or decreases interest rates, they are also either benefiting or hurting from those tools that are being implemented. While states with high unemployment might need a stimulus more, it is also general in the sense that monetary tools can't be directed to solve a specific problem or boost a specific industry or region. Although they have, suggestions on where the money or which industry should be prioritized, but sometimes those industries do not come to financial institutions for borrowing, so it could not exactly be properly implemented. The risk of hyperinflation. When interest rates are set too low, overborrowing at artificially cheap rates can occur. Okay, even if they don't need the money, businesses or individuals, when they see that the interest rates are low, there could be overborrowing. This can then cause a speculative bubble whereby prices increase too quickly and to absurdly high levels. Adding more money to the economy can also run the risk of causing out of control inflation due to the premise of supply and demand. If more money is available in circulation, the value of each unit of money will decrease, purchasing power will be lowered, and then will decrease given an unchanged level of demand, making things priced in that money nominally more expensive. Okay. Pros and cons of fiscal policy. On the other hand, again, fiscal policy refers to the tax and spending policies of a nation's government. A tight or restrictive fiscal policy includes raising taxes and cutting back on federal spending. Okay, so essentially they're trying to lower the money supply. Okay, and then a loose or expansionary fiscal policy is just the opposite and is used to encourage economic growth, putting more money into the market. Many fiscal policy tools are based on Keynesian economics and hope to boost aggregate demand. So pros, advantages, can direct spending to specific purposes, okay, which industries would receive them. Unlike monetary policy tools, which are general in nature, a government can direct spending towards specific projects, sectors, or regions to stimulate the economy. Regions, which locations NCR ba? Or in, let's say, in major cities or in the provinces, right? Stimulate the economy where it is perceived to be needed the most. Can use taxation to discourage negative externalities. Taxing polluters or those that overuse limited resources can help remove the negative effects they cause while generating government revenue. Okay, by increasing taxes, it would make businesses think more about how they're going to spend their resources, because with increased taxes, they would have lesser resources to use, and in that sense, they would be forced to be more efficient in utilizing their resources, not spending them needlessly on unnecessary things. Okay. Short time lag. The effects of fiscal policy tools can be seen much quicker than the effects of monetary tools. Because when the government spends, they just spend. They don't necessarily control or monitor the actual effects that it's having on the economy. But whereas on the part of the monetary policy, they have to do it very, gradually, slowly, so that they would not, whenever they inject money into the market, they do it very slowly so that they could monitor and control its effect, especially on inflation. Cons, disadvantages may be politically motivated because this is the government. Raising taxes can be unpopular and politically dangerous to implement. If you would remember, the person who, who proposed the bill to increase VAT to 12%, the following election he was not voted. Alright. So there are things like that. So politicians, when it comes to proposing bills, especially taxes, they normally want to favor the businesses and the individuals. So you have the train law decreasing the tax rates for individual taxpayers, and then you have recently the create law which decreased the corporate tax rate. So they are trying to get the favor of businesses and individuals, but let's not be fooled, okay? Tax incentives may be spent on imports. The effect of fiscal stimulus is muted when the money put into the economy through tax savings or government spending is spent on imports, sending that money abroad instead of keeping it in the local economy. Okay, so that could happen. Can create budget deficits. A government budget deficit is when it spends more money annually than it takes in. If spending is high and taxes are low for too long, such a deficit can continue to widen to dangerous levels, essentially national debt. Okay. During this time, pandemic, again, there's a lot of spending on stimulus, aids, and then of course you have your vaccine imports. There's a lot of debts that the government took, and so we'll see how we're going to fare. We'll check the FS of the national government later on. Bottom line, the monetary and fiscal policy tools are used in concert to help keep economic growth stable with low inflation, low unemployment, and stable prices. Unfortunately, there is no silver bullet or generic strategy that can be implemented, as both sets of policy tools carry with them their own pros and cons, and of course how the market is actually going to respond to the implemented tools. Okay? Used effectively, however, the net benefit is positive to society, especially in stimulating demand following a crisis. Okay? So this is it for the discussion comparison of fiscal and monetary policy and then their respective pros and cons. Alright? So that's it for this one. Thanks and bye.